Accounting is founded upon a set of fundamental principles and concepts that ensure financial statements provide useful, reliable, and comparable information to stakeholders. These concepts underpin the preparation of financial statements under the conceptual framework for financial reporting and IFRS accounting standards, guiding accountants in recognizing, measuring, and presenting economic transactions consistently. The program emphasizes that these principles form the conceptual basis for all subsequent financial reporting standards and accounting practices. 1. Going concern. The going concern principle assumes that an entity will continue its operations for the foreseeable future and has neither the intention nor the necessity to liquidate or significantly curtail its activities. This assumption affects the valuation of assets and liabilities because assets are measured based on their continuing use rather than immediate disposal values. If the going concern assumption becomes inappropriate, financial statements must be prepared on an alternative basis, often resulting in significant asset impairments and liability reclassifications. The assessment of going concern is a fundamental responsibility of management when preparing financial statements. 2. Accruals accounting. The accrual basis of accounting requires transactions and events to be recognized when they occur rather than when cash is received or paid. Revenue is recognized when earned, while expenses are recognized when incurred and matched with the related revenue. Consequently, financial statements provide a more accurate representation of economic performance by reflecting obligations and resources existing at the reporting date. Accrual accounting enhances comparability between reporting periods and improves the predictive value of financial information. 3. Materiality. The materiality principle states that information should be disclosed if its omission, misstatement, or obscuration could reasonably influence users' economic decisions. Materiality depends upon both the size, quantitative significance, and nature, qualitative significance, of an item. Insignificant items may be aggregated or omitted where they would not affect decision-making, allowing financial reports to remain clear and understandable without unnecessary detail. Materiality supports the efficient presentation of relevant financial information while avoiding excessive disclosure. 4. Offsetting. The offsetting principle prohibits the netting of assets against liabilities or income against expenses unless specifically permitted by IFRS accounting standards. Presenting items separately provides greater transparency and enables users to evaluate an entity's financial position and operating performance accurately. Unauthorized offsetting may conceal important financial risks and distort financial analysis. 5. Consistency. The consistency principle requires accounting policies and presentation methods to be applied consistently from one accounting period to another unless a change improves the reliability or relevance of financial information or is required by an accounting standard. Consistency enhances trend analysis and inter-period comparability, enabling stakeholders to assess changes in performance without distortions arising from arbitrary accounting policy changes. 6. Prudence. Prudence refers to exercising caution when making judgments under conditions of uncertainty to avoid overstating assets and income or understating liabilities and expenses. Prudence does not justify deliberate conservatism or bias but promotes neutral and careful estimation where uncertainty exists, such as provisions, impairment losses, and doubtful debts. It contributes to faithful representation while maintaining the credibility of financial reporting. 7. Duality. Dual aspect. The duality principle forms the foundation of double-entry bookkeeping by recognizing that every transaction has two equal and opposite accounting effects. This concept is represented by the accounting equation. Assets equals liabilities plus equity. Every transaction simultaneously affects at least two accounts, ensuring that the accounting equation remains balanced. Duality supports completeness, accuracy, and internal consistency throughout the accounting system. 8. Business entity concept. The business entity concept treats the business as a separate accounting entity distinct from its owners or managers. Only transactions relating to the business itself are recorded in its accounting records, while personal transactions of owners are excluded. This separation ensures that financial statements faithfully represent the economic activities of the reporting entity and facilitate objective performance evaluation. 9. Historical cost and current value. The historical cost basis measures assets and liabilities at their original transaction cost. This approach provides objective, verifiable, and reliable information supported by documentary evidence. In contrast, the current value basis measures assets and liabilities using updated values such as fair value, current replacement cost, or value in use, reflecting current economic conditions and enhancing relevance. Modern IFRS accounting standards increasingly combine historical cost with current value measurement where more decision-useful information can be provided, balancing reliability and relevance. 10. Substance over form. The substance over form principle requires transactions to be accounted for according to their economic reality rather than merely their legal form. Where legal documentation differs from the underlying economic substance, accounting treatment should reflect the true commercial effect of the transaction. This principle prevents manipulation through legal structuring and promotes faithful representation of financial events. Substance over form is fundamental to IFRS-based reporting because it ensures that financial statements reflect the actual economic resources, obligations, and performance of the reporting entity rather than superficial legal arrangements.